At this point, when the markets are falling, looking at my mutual fund portfolio, I sometimes think कि काश मैं अपने mutual funds investment को जब markets ऊपर जाए तब equities में डाल देती और जो markets नीचे जा रहा है उसमें मैं debt पे डाल देती और मैं बार बार switch कर पाती without selling again and again like a transfer. If you are thinking the same, then you are at the right place क्योंकि आज हम बात करेंगे systematic transfer plan की या STP की. SIP तो आपने सुना ही होगा, ये STP है. What is it? What are the benefits? Should you invest in an STP and how does it work? मैं सब बताती हूँ. पहले बात करते हैं what is STP की. STP is systematic transfer plan which allows investors to transfer their financial resources from one mutual fund to another at predefined intervals without any hassles. The transfer can happen periodically in months, weeks or quarters. मतलब आप एक प्री डिटरमाइंड टाइम सेट कर सकते हो कि इस साल आपका इक्विटी म्यूचुअल फंड इन्वेस्टमेंट जो है डेट में ट्रांसफर हो जाएगा पूरा का पूरा. नाउ व्हाट आर द टाइप्स ऑफ STP? There are three types: flexible STP, fixed STP and capital STP. Flexible STP is one where investors can choose the total amount to be transferred based on immediate needs. Like now, say you have an equity mutual fund and markets have just started declining. You can transfer some amount from this existing mutual fund to a debt fund to keep safe and keep some in equity still, but you need to see the scheme's performance before deciding to invest in it. Fixed STP is one where the total amount is transferred from one mutual fund to another mutual fund and the amount is fixed and predetermined by the investor. So here you don't have the flexibility to change it as per your immediate needs. Third is capital STP, which is one where the total gains from your fund's market appreciation is transferred to another promising scheme for more growth potential. So whatever your return is, that will be transferred to another scheme automatically. Now, what are the benefits of this STP plan? You probably have guessed it when I was telling you about it already, but let me still tell you the benefits. First, you get higher returns because it allows you to increase your returns on investment by switching to a more profitable enterprise during market fluctuations. Second, stability. During high degree volatility in the markets, investors can transfer funds to a less volatile instrument, keeping them safe and secure while earning stable returns too. Third, rupee cost averaging. You have the freedom to invest in funds when their average price is low and sell when their market value is increased while realizing capital gains on individual securities. Fourth, optimal balance. The aim is to create a balanced portfolio with mix of equity and debt. So now who should invest in this instrument? Well, for those who have limited resources or funds but want high returns can actually look at investing in it. It is also suitable for people who want to reinvest in safer securities during market fluctuations. Say I am an employee and I got a lump sum bonus. What I can do with it is that I can park that money in a debt mutual fund and then from there I can start an STP into the same fund where I have my SIP. Or if I am a business person, I can actually invest a lump sum amount in a debt mutual fund for say 5 to 10 years and then start an STP into an equity mutual fund. With that, I can have a retirement corpus. Or I can do a vice versa thing too. Say I have a financial goal like buying a house or a car. I fulfill that goal by investing in an equity mutual fund that is giving me high returns. Now I have fulfilled that goal. So what I can do is that I can start an STP where I can transfer my funds from an equity mutual fund to a safer security that is a debt mutual fund. Now, how to invest in it? Well, you first need to choose a mutual fund as the destination fund, which usually is an equity mutual fund, and a mutual fund as a source fund, which usually is a liquid fund. So source fund से destination fund में transfer होगा. Then you need to decide how often you want the transfer of funds to happen, daily, weekly or monthly. And remember that this is a lump sum investment scheme, so you need to have some capital in hand. Now, what do you need to keep keep in mind before investing in an STP. 1. Ask your financial advisor, obviously. 2. It is for long-term investment, not for a short-term period. Third, an investor should have considerable knowledge about market trends and patterns, because understanding the markets is key to understanding fluctuations, and when to transfer your funds need to be understood that way. 4. Exit load and tax deductions should be kept in mind while calculating expected returns in an STP. The risk cannot be eliminated too. 5. Cost of transfer also needs to be seen beforehand. And last, remember that the eligibility criteria for investing in an STP mutual fund are 6 transfers among different investment schemes as per SEBI. For more such news and views, keep watching ET Now and let us know in the comments if you already knew about an STP.
If you like this video, then like, share and subscribe to ET Now.